Howdy, y'all. Welcome back. It's the weekly wrap up from DSA Financial Group. I am Raymond Dahlman, your humble host. Hope everyone is having a fantastic week. It is beautiful outside here in Colorado. It was a little overcast earlier. Had some storms go through. Looks like north of me. Looks like they went through Denver. But we have a 3-day weekend we're heading into. It's Labor Day weekend, and hope everyone has some fun plans. I'm probably just going to hang out here. I didn't make any plans with the wife, so we're just going to hang out. She has the day off today too, so she's out doing fun things. So anyways, it's after 3 o'clock here in the Mountain Time Zone. The market's been closed for an hour, so let's go ahead and jump in. Let me share a screen with you so I can show you what's going on in the markets. And my dog is upstairs barking like crazy. So, all right, here we go. Let's see how the Dow Jones did this week. Let's take a peek at its returns. Looks like the Dow was down about 0.25%. S&P looks like it was up for the week, up about 0.57. Nasdaq looks pretty decent. It was up 1 1/3. The Dow Utilities 1 1/3, and the Dow Transports, they look like they're down. Yeah, down a little over 1%. So it looks like the Dow 30 and the Dow Transports underperformed this week. The S&P and the Nasdaq were our best gainers from the way it looks. So all in all, not a terrible day. So let's go ahead and remove that. Stop that. And let me go ahead and share. All right. Share. There we go. All right. So as far as the news right now, we had the non-farm payroll came out. It was kind of disappointing. I'll touch on that in a minute. The Dow was down, due to obviously the report that came out. And let's see here. Let's talk about NASDAQ. Anything else of interest? Gold's been up this week. Gold did very well today. Gold, silver. Oil was a little weak. I saw that headline somewhere. Yeah, right here. Crude oil extended losses. It was up over 70 and has it fell about 1% today. Due to a weaker dollar, I've noticed that the dollar index has slipped from the 93s down into the 92s. So it's kind of a mixed bag right now. The jobless rate fell to a pandemic low of 5.2%. I'll have little details on that. So, all righty, well, let's go ahead and look at the jobs numbers. Initial jobless claims came in at 340,000 against a forecast of 345. Let's see, last week's numbers were revised up 1,000 from 353 to 354. All right, let's look at the continuing jobless claims. Came in at 2.748 million against a forecast of 2.775 million. Again, the trend is continuing in a downward direction. Last week's numbers were revised up about 40,000. So still not great, but we are getting down to much, much closer to pre-pandemic levels. All right, next one, the unemployment rate. I just talked about this. Unemployment rate came in at 5.2 against a forecast of 5.2. And, if we look back here over the last few months, since last October, we've gone from 7.9 down to 5.2. So the trend is still steadily going in a positive direction, which is certainly excellent news for us. This is the bad report that came out. Non-farm payrolls came in at 235,000 new jobs added against a forecast of 750,000. This is the second time in just a few months where the forecast. Actually, a lot of these forecasts were off. In April, we came in at 916 against 647. In May, we came in at 266 versus 978. So you have to wonder, do these forecasters have a brain in their head, or are they just throwing numbers at the wall and seeing if they're accurate when the final numbers come out? So who knows? All righty. U.S. trade balance came in at a negative $70.1 billion. The forecast was negative 71 billion. It did improve from the previous months. We were at negative 73 billion. That was revised to the better from 75 billion from last month's numbers. And if you look at it, the trade deficit did shrink a little bit, but it is still quite large. I mean, going back, even 2 years to September of 19, the trade imbalance was negative 54 billion. And we're 50% higher right now. So it does continue to climb. It does give me some concern, but no one really cares what I think. So, I mean, other than you guys who actually take the time to watch this. So, and this is something, I've been talking about the rig count, how it affects gas prices around the country. And our rig counts had been slowly climbing over the last, really since, what was that, last fall, I believe, when it started going back up. And we had a steady increase of the rigs in use, but with Hurricane Ida that just came through and slammed, the Gulf Coast and, all the way up into, the bad weather went all the way up into the Northeast. But I'm sure we took a lot of rigs offline in the Gulf. So that probably explains the 16 rig difference from last week. So. All righty. And I had a couple of articles I wanted to share with folks. I shared this on the social media streams, Facebook and Twitter, for my company page. This first one comes from Reason Magazine. Eric Boehm is the author. This was published on 9/1, so 2 days ago. Social Security will be insolvent in 12 years. Without policy changes, beneficiaries will receive only 78% of what was promised starting in 2034. So that is 13 years from now. So I'm going to go ahead and read through a little bit of this, and I will attach it to the show notes if you want to take the time to read it yourself. I would strongly suggest it. All right, starts out. The fiscal crisis looming over Social Security is no longer a distant threat. The national pension system will be insolvent by the time workers now in their mid-50s are ready to retire. The annual report to Congress from the Social Security trustees released this week paints a grim picture of an entitlement program that was already veering towards insolvency before the COVID-19 pandemic accelerated that trend. The trustees now estimate that Social Security will be unable to pay the full amount of promised benefits by 2033, 1 year sooner than the same report estimated last year. Absent any policy changes, beneficiaries will receive just 78% of what they've been promised starting in 2034. The pandemic caused a spike in retirements, but the underlying issues with Social Security remain the same as they've been for decades. The math simply doesn't add up. Social Security will see a negative cash flow of $147 billion this year, and the deficits will keep adding up as the population ages and there are fewer workers paying into the system relative to the number of retirees collecting benefits. Last year, there were 65 million Americans getting benefits from Social Security, while 175 million paid into the system via payroll taxes, according to the trustees' report. That's less than 3 workers for every beneficiary, a near historic low. Those deficits will eat up the Social Security Trust Fund over the next decade, and insolvency awaits. The trust fund itself is actually an accounting fiction. It contains nothing except IOUs that the government has written itself over the years. In some ways, then, the country is really facing the evaporation of the pleasant fiction of the trust as a backstop for its largest entitlement program. And this is something I've talked about with clients over the years, is that the Social Security Trust Fund at one point had dollars in them or in there. Not that you had your own account. It was just a general fund where all the, a big kitty where you pushed all your bets into, and then it's divvied up for those who are consuming benefits at that time. Well, what happened is, I forget when it was. It was either that, I think it was in the 90s, but don't quote me on that. I don't have the exact date. But our legislators went into the kitty or into the trust fund, and instead of took the dollars out of there and replaced it with bonds. Well, bonds are just IOUs. Anyone who's took Econ 101 knows that bonds are just a repayment vehicle for the money or the cash that you give them today. They'll pay you back 10 years, 20 years, 30 years down the road. You'll get your principal back, plus you get interest during that time. Well, if the dollar collapses and all those IOUs in there are denominated in inflated dollars, it's not really going to be worth it. So that's the big problem with Social Security. So let's see here. The last time Social Security recorded a deficit in 1982, I was in the second grade. It spurred lawmakers to make several changes, including an increase in the payroll tax that funds Social Security to keep the program solvent for a few more decades. This time, however, there's almost no indication that either major party is prepared to act. And this is really my biggest problem with the federal government at this point, is all they want to do is, increase spending, increase taxation, and have no solutions to pay down the nearly $30 trillion in debt. I think it's over $100 trillion in unfunded liabilities, or somewhere near that number. This is going to come, collapsing down at some point, whether or not it's, in the next year or the next 10 years. I see this as unsustainable. I mean, if, your neighbor made, $30,000 a year and had $300,000 in debt, and, they're telling you about the new pool they're putting in, with their welfare payments, I mean, you'd be like, what the hell are you doing? This is the same thing. And there's just no responsibility. The way I look at it is, our Congress people have a fiduciary responsibility to ensure that our rights and liberties are protected, and to be good stewards of, the general fund that we provide to them. But hey, again, no one cares what I have to think. The bulk of Social Security's funding comes from 12.4% payroll tax that's split 50-50 between employers and employees. Well, unless you're self-employed like myself, and then you pay both sides of that. So, and then you factor in another 3% for Medicare, and you're already losing 15% of your gross wages off the top. So, just because you don't see that, half of the Social Security and Medicare costs coming out of your paycheck, it's part of your compensation. You just never see it. All right. Only on the first $142,800 of income is subject to the tax. Lifting or removing the cap or raising the tax rate would generate more revenue for the system. Alternatively, reducing benefits for some or all beneficiaries, either by instituting across-the-board reductions or by means testing in some way, could bring Social Security liabilities in line with its assets. Do you think anyone is actually going to do this? I mean, seriously, what politician is going to campaign on, we're going to either increasing spending never seems to bother anyone. We're going to reduce spending in the government somewhere else to make this solvent. I don't know of any federal employees who are going to volunteer to give up their cushy jobs with their pensions and their nice benefits so that the Social Security system could be solvent down the road. So I just don't see these people leaving the public sector and becoming productive members of society. So it could happen, but I'm not counting on it. Let's see here. The more time that passes, the heavier the lift will be, according to analysis from the Committee for Responsible Federal Budget, which advocates for low deficits and sustainable entitlement programs. Delaying action until insolvency hits in 2034 will make the need for increased taxes or benefit reductions about 25% larger than if Congress acted today. So again, I don't think anyone will do anything. I mean, you could come back to this video in a year and say, Ray, you were wrong. Some smart guy decided to actually fix the system, but I just don't see it. All right. The last one. Hey, my wife's back. So I need to wrap this up quick. How to identify a bubble Wall Street says is not a bubble. So who is this written by? Charles Hughes Smith. And this is from LouRockwell.com. It's kind of an aggregator of a lot of good articles. So, and my ring system is buzzing because my wife just pulled in. It's really simple to identify a speculative bubble of epic proportions in stocks. If Wall Street says it's not a bubble, it's a bubble. As I explained in The Smart Money Has Already Sold, from the long view, the entire game of investing, wink, wink, boils down to one dynamic. Wall Street and the Federal Reserve inflate an unprecedented debt-funded speculative bubble and then lure retail investors, gamblers, in with the promise of enormous gains are just starting. There's so much more money, easy money ahead, etc. Then Wall Street distributes sells over time so as not to alert the complacent herd of retail punters its shares of overpriced rubbish to bag holders, and then everyone's surprised the market suddenly crashes as the unsustainable bubble pops. Wall Street has a long practice of how to reassure the herd, since investors have juiced the market higher for years at every dip, With the Fed's free trillions offering a helping hand, the bag holders have been well trained to buy the dip, even as the wheels come off of the whole. It's time. This time, it's different scam. So, and it goes through the different collapses we've had. The .com bust, the mortgage bust, and now what we're heading into. I don't know if you would call this the COVID bust, but it's a pretty short article. But just my advice to everyone out there: when you're investing, if you're doing it on your own, be careful, watch the trends, make sure that, if you feel uneasy, it's better to be safer than sorry. So, all right. Well, that is everything that I had today. So hope everyone has a fantastic weekend. If anyone needs anything from me over the weekend, call or shoot me an email. I'll be here, and I'll probably do a video on Monday, even though it's a holiday, but I don't know for sure. So have a great weekend, and I'll talk to y'all later. Bye.